So when it comes to those properties, obviously you guys have that one. You guys have a bunch of other ones I've never seen. What do you look for? Do you surf? Are most of those deals off market? Do you go on like Zillow or some of the commercial real estate websites and go like what do you see that you think like wow that's a good deal? We should look into that.
Yeah, we've done both. So we've bought on market, and with the exception of this past quarter, every quarter we're sending out a mailing to a very targeted list of multifamily properties in our target market, right? And so the owners are consistently getting a letter from us saying, "Hey, we're interested in buying your property. Here's who we are. Here's what we've done already. If you
Mm-hmm.
want to take a look at some of our other properties in the area and see how we've turned them around, please do that. Give us a call. We're interested in buying."
Mm-hmm.
Um, and really, we've gotten a lot of our deals that way, but also through our property manager. So our property managers, when they find out that an owner is looking to sell, because they know that we take care of our residents and we put money into our properties and improve them and whatnot, they call us first,
Right.
because they know they like to work with owners that are interested and invested in improving the community.
Right.
So
Yeah. No, definitely. That's awesome.
Yeah, I'd say I'd just add that I think about 80% of our 80 to 85% of our units did come from off-market deals, and we're still getting some here and there, but they're significantly under the market price.
Mm-hmm.
So we can and but kind of to address your question on like what do we look for too is we look for like where we can add value. If it's already maximized in terms of like rent and rehab and stuff, then we can't add a lot of value. They're going to charge a high price for it.
Mm-hmm.
So we look for those under market rents where we can push and if it needs renovation. And one of the great things about the market that we're focused in right now is there's a lot of landlords that don't want to attend to like maintenance issues like Joe said. There's still the shag carpet from the 80s and a
Yeah.
lot of places, and wall paneling, so the yellow and pink tubs, all of that stuff we find on a regular basis. So that strikes us as an opportunity. A lot of people don't want to go in and deal with that, so they like to buy turnkey.
Mm-hmm.
But we're willing to put the money into it and make it nice. And that also keeps our rents higher than the market average, and it keeps our properties occupied too. So,
Right. So because it's like it's brand new, if you will, people
mhm.
kind of want that. So um, now when it comes to touring these properties, like obviously you can't pull a simple comps list. So do you guys have like some sort of formula equity you're looking to have built in before you purchase? Like, hey, I like to get this off market deal for 10, 15% off the market. And if so, how do you assess its value? Would you go to like a bank or do that? Like, I guess talk to me on assessing these properties' value.
you want to take that one,
So
Chris?
yeah. So I would say that we look at a 5-year hold on any property,
Mm-hmm.
and we target it, we target internal rate of return of roughly about 20% for the specific market that we're in right now, which is a little bit higher than some people target for other markets in the southeast. And it's really just because of the market, the population, the job diversification and growth. It's not necessarily a growing market, so we have a little bit. It's a little bit higher risk of an area, so we have a higher tolerance for that.
Mm-hmm.
So, yeah, we typically target somewhere around a 20% IRR for that, and then we'll anywhere from 15 to 20% plus in cash annual cash flow. So if we invested $100,000 into the property, we'd want to get somewhere around $15,000 at least out of it on an annual basis in terms of cash flow.
Oh wow!
And there's other
Sorry, continue.
no, there's other metrics that we look at, but those are kind of a couple of the key ones
Mm-hmm.
that we look for.
That's so like you wouldn't really look at like cap rate or things like that. Like what would be like an ideal guess cap rate for you guys? I know on the low end, like a 6.5, 7 cap is more like massive hotels. Where do you guys see your cap rate lying at?
So it's really come down over the past 3 years. I think when we were first buying, we bought like a 12 cap, and now we're seeing it. We had properties appraised at about a 6.5 cap
Really?
recently, and
Why is
so
that?
it's
Like,
just the market
yeah.
demand and what other things have sold for. So when you talk about cap rate, it's you don't want to look at it as, hey, this is what I'm going to use for value, because you really want to focus on your net operating income
Mm-hmm.
and use that to focus on how much you should pay for the property. But your cap rate really is affected by what other properties have sold for recently in that market for that asset class in that area. So it's very hyper focused, but also by asset class, and it can swing value one way or the other. But I guess a good kind of rule of thumb, and this also goes back to what Chris was saying about adding value to the property, and that you could force appreciation that way versus residential. If you think of, for every $1 of value that you add to your net operating income, at a 5% cap rate, you just added $20 worth of value in that property. So you really can force appreciation in a big way, but when you look at it in terms of the sale, you want to be looking at how much net operating income am I going to get out of this thing, and what are other buildings of the similar asset class and type in the area selling for recently.
Okay. Cool. So, kind of segueing into the next question, you say the cap rates went down a little bit. Now, I know you guys are focusing on bigger and better markets, right? I think you guys are expanding out of more North Country stuff and looking at more South.
Lost you.
Yeah, my camera loves to do that. Sorry about that. Right. So where would you see, I guess, the market heading? One, it's got two-parter. Where would you see, I guess, the overall market heading? And B, where are you guys? Like, what counties slash areas in the U.S. are you guys looking for, like, to potentially purchase more? I know you mentioned Georgia. I don't know if you guys are still looking in New York. I guess, yeah. Talk to me where you guys are foresee, I guess, where you purchasing more units.
Yeah, as far as like the overall kind of market going, we're seeing interest rates rise right now. They're rising, fairly quickly. So I think we are going to see a slowdown. I'm down in Florida right now, where we are starting to see a little bit of a slowdown. We're starting to see more price drops, just in the single family residence market. But so you're seeing like more days on market, all of that. So I think we will, as the cost of capital becomes more expensive, we'll see a little bit come down, because especially on the single family front, in certain markets, it's almost becoming too expensive for the middle class person to go buy a house. So once you get up to that $500,000, $600,000, $700,000 per house price range, it gets very difficult. And then you add the rising interest rates on top of that. So and then inflation in every other area. But so I think we will. I don't know that we'll necessarily see a huge downturn. Back in 2008, that happened from a lot of poor lending practices. But as people lose their jobs, or if they do lose their jobs, that could affect it. So there's so many triggers that it's very hard to predict. But I think we'll see a plateau here, and then that'll probably hold steady for a little while. And you'll get those investors that say, "Hey, I'm waiting for the market to come back down or interest rates to drop." And
Right.
as those people stop buying, the demand will slow down, and we'll keep buying.
Yeah.
And there's a shortage of 5 million residential units in the United States right now. And if you look at how long it'll take to build 5 million units to house people, I mean, it's going to take the better part of a decade for supply and demand to catch up with one another, from what I've read. And so that's why we're still bullish on multifamily and just residential real estate in a big way, and why you're seeing prices go up so much. I mean, there's so many people bidding for the same house.
Mm-hmm.
and it's not just people like you and I. It's hedge funds now too, or
Yeah.
foreign investors that realize that the supply and the demand in the U.S. is out of balance, because essentially what happened after the crash was that builders stopped building, and there's a 10-year lull where they were just so far behind of building because they didn't want to get caught with their pants down like they did back in 2009.
Right. Right. Huh.
And I would just add that there are stats out there that you can watch. Like there's multifamily housing starts. I think it's free data that's available. So kind of looking at some of that, and you can see that on an annual basis and in what states, and I think even what cities, like how many multifamily housing 5 units or more starts there are in terms of like building building permits being opened. So those are good indicators of where you see some of the contractors and stuff, like how they feel about it. So it seems like overall the market's still pretty bullish.
Okay. So a few years ago, it was kind of word that building was cheaper than buying. Well, now that script's kind of flipped due to the increase in lumber. Do you guys ever foresee yourself building new or always buying and rehabbing? Like, because there's such an opportunity there with adding equity, or have you guys maybe discussed building? Um,
We have. I think it's kind of almost like the evolution of a real estate investor to at one point get to development,
mhm.
right? Because there's a lot of money to be made in development if you know how to do it, and it's a whole lot more complex, cumbersome. It's a longer payout, so you got to have the financial wherewithal to last the timeline from permitting all the way through construction and sale, leasing up. So you could be talking 3 years of costs going out the door before you get a dollar back. So development is big, and I think at some point we'd love to do it, but it can just have massive um, cash windfall on the back end. So that's why a lot of real estate developers you see with all the crazy shiny cars and stuff we were talking about
Yeah.
beforehand. It's a lot of money, but you also have to get to a point where you can kind of withstand the storms on the way
Right.
to that.
Right. Yeah, and even with, I guess if COVID taught us anything, any job can be shut down in an instant. I mean, some of those guys probably are still halfway done building, units they started building in 2018, 2019. So,
Yeah.